Welcome to the Emerson Group Wealth Call for May 2025. My name is Nick Emerson and I'll be your host. And I am the owner and operator of the Emerson Group, real estate professionals, where we specialize in helping rental property owners build, protect, and pass on generational wealth through real estate investment and specifically the 1031 exchange or tax-deferred reinvestment strategies. And today's call, I'm excited to be sharing with you my personal journey of exchanging from my North Carolina rental property to sunny San Diego. And the purpose of today's call is really to help you understand more about what my financial analysis process was for deciding whether to keep my rental or exchange the property, why I made that decision, and through that process, walk you through exactly what the sale entailed, what I accomplished, some lessons I learned working with other agents in this space, and ultimately how I decide what properties are worth pursuing or passing on for investment purchase. And then lastly, we'll go through the initial process of what I bought, and we'll be sharing an awesome story about how we're going to go through renovating, adding square footage, adding another unit, and have a tremendous product and final presentation to share with you throughout that process. So for today, we're really going to understand a comprehensive analysis of making informed decisions for rental property ownership. So we'll begin with the purchase of the Charlotte property, which occurred in 2021. I want to set the scene of what my ownership looked like, what the snapshot review was, and ultimately where we are today. So for the purchase, I purchased a detached single-family home in 2021, April, with the goal of renovating the property, refinancing it, and then stabilizing it by renting it out long-term. Through that process, I bought the property at $289,000 with 25% down conventional, and I spent a total of $54,000 on renovations. With this, if you break this down, you'll see that my monthly payment for my principal and interest was roughly $1,020, along with my insurance and taxes at $362. So it was a great investment purchase, and I realized a cash on cash of 7.75%, which in today's market would be phenomenal purchase. Now, what I want you to see is my ownership period from 21 to then looking at my property in 2024. Now, a few notes I want to make here is I did refinance the property as mentioned, and I pulled out all the money that I invested into it as far as the down payment and the purchase. Through that, I bought 2 other investment properties. But what's most important to understand is the reason why my loan balance went from a lower to a higher when reviewing 21 compared to April 2024. So going back to the renovation spend and total investment for down payment, we have a total of $127,100 invested in the property. Through that process, that's going to play a role in understanding what capital you have in your rental property. And as you go through the ownership period, ultimately, how hard is the capital working for you? And as I stated, initially, we were making $821 a month with a 7.75% cash on cash. However, as we take a look at our 2024 snapshot, we're going to understand that ultimately the loan balance went up and the way in which our capital is working for us, well, it wasn't working as hard. Hence why evaluating where we're currently at so that I can determine whether it made sense to continue keeping it as a rental or if now's the time to make an exchange and head off to sunny San Diego. Before we get into taking a look at the analysis of the Charlotte property for our snapshot to determine what we do next, I also wanted to mention one of the features and benefits that was utilized during the ownership period, which is cost segregation. It's a term that's often thrown around, but not commonly understood. And so for this space, what I was able to do is employ U.S. tax advisors to put together a cost segregation report. Now, what is cost segregation? Well, cost segregation is a way to basically repackage the construction of your property into different depreciation timelines. So normally, straight line depreciation for your property for rentals is 27.5 years. In this case, if you're doing a cost segregation report, what you're actually doing is you're reclassifying different components of your property: foundation, frame, bathrooms, flooring, and through that, in the IRS ruling, you're able to kind of advance or really accelerate your depreciation. So components that would normally be in 27.5 years are actually brought up to a 5-year period or a 7 or a 15 year. And that allows you to get a lump sum depreciation write-off in that year and years following. So with this is also something that will play a role in my decision process, as naturally, if you're going to accelerate the depreciation table, well, you're going to have less of it on the back end. And therefore, if the goal is to minimize tax implications and preserve income, ultimately you want to have as much depreciation as possible to offset that. As you'll see in these examples, I wanted to show you my actual cost segregation report, as it shows the amounts associated with the basis for the property. So we're at $221,000 for the basis, meaning that's when I purchased it, for $289. $221 was allocated towards the improved, the remaining portion for land. Now, again, this demonstration or illustration rather shows you the different costs within the 5-year, 15-year, and 27.5 year. Furthermore, if you take a look at this other chart, it gives you a more itemized breakdown of exactly what is in the 5-year property summary, the 15-year, or the standard 27.5 year. So as you'll see, we were able to capture almost $45,000 in the 5-year and $17,000, almost $18,000 in the 15-year. So great, what does that mean? What does that do? Well, in tax year 2022, I was able to essentially write off nearly $70,000 plus in depreciation benefits, which in return reduced my tax liability by over $25,000 that year. So what I want you to take from that is that there's more than one way to win. And ultimately, if you can stack together multiple options, or basically options that will allow you to succeed in several buckets, naturally that's going to improve your position and your opportunity for greater wealth accumulation throughout the course of time. So as we jump back into the Charlotte rental snapshot, we're going to look at what was I analyzing or reviewing before I ultimately made a decision of whether to exchange or keep the property. So walking back to this time period, I was informed that my tenants were going to be vacating the property at the end of October in 2024. So I knew right away that we're going to be in a situation where we're renting or releasing in a period that's typically softer, right? November, December is not going to be as in demand as far as people looking for places to stay. And there's going to be some work that needs to be done. So ultimately, I was going to have to spend money or basically give back everything that I'd earned in net income from the previous year and a half. When looking at those options, I really wanted to say, well, now that I'm understanding that I have to re-rent it, I have to commit money and time, is now a time I should consider whether exchanging might make sense. Take a look at our snapshot here for September 1st, 2024. And what you'll see is we had an estimated value of $600,000, loan balance of $343,000, and a monthly payment of $2,350, which when you include the management fee came out to $2,568 a month. Now, what does that mean? Well, it means we're making far less net income per month per year. As you'll see, we are realizing about $157 a month in net operating income, which is good for just under $2,000 a year. Now, that information doesn't mean much unless we know how much capital or equity we have in the property. When we're able to look at and pair our net operating income for the year of $1,884, divide that by our current equity position or net proceeds you would realize for a hypothetical sale, what we find is, well, currently I'm making less than 1% on my money. In fact, 0.008%, so 0.8%. Obviously, that's not serving me well. However, it has served me well by building equity. So we had a total of $210,000 of potential equity to pull from this property for an exchange. So these are the information I'm looking at to understand, what do I have on paper with clarity? Exactly my net operating income, exactly my equity, so that I can make an informed decision to know, comparing what do I have now, and then what do I have, or what could I have if I were to go out in the open market and look for an investment position, whether it's a physical property asset or a passive one in a fund. There's many different options you can evaluate to see if there's an alternative option that better serves you, depending where you're at in the investment game or season of life. All right, decision point. What were the main considerations that I was looking at when determining whether or not to make a change? Well, when evaluating the considerations for keeping the property or holding it, main considerations were really time and money and opportunity. So for the Charlotte property, it's more of a passive income and more passive investment, meaning I'm not personally out there having to swing the hammer and paint the walls. So therefore, there's value in that for me, given I'm a busy professional. However, on the flip side, there's not a whole lot there to be realized at this current time horizon, because I'm not making a lot of return, and appreciation has been curbed there in the Charlotte area. So what would be the benefit if I were to flip my position from a passive investor to an active investor? Meaning, if I could physically influence a property here in San Diego, what would the benefit or the value be versus maintaining a passive position? Secondly, the depreciation table. Given that I have used accelerated depreciation, my table for depreciating write-offs is truncated, right? It's shorter. So if I reinvested it, I could capture a larger table and conceivably do another advanced depreciation for cost segregation, which of course, as I promised you guys, it's more money in your pocket, another out to win within your investment position. Tenancy expiration. Obviously, I mentioned they're leaving in the October month, which is not ideal being in the holiday season. And then lastly, what are alternative rental income options that I could pair with this property that might produce a better income or option? So looking at what is the rental growth right now if I were to re-rent it? Can I do a short-term play? Is there a mid-term option, maybe a corporate rental? Looking at all those options, what was discovered is that it's going to be a larger investment to put into it for staging, repairs, and ultimately the rental market in the shorter term space is currently not as hot as it used to be. So looking through those different considerations, I've really comprehensive understanding of what do I have, what can I do, and what should I do. Now, as we flip to the exchange decision point, I'm looking at, if I were to repackage this $210,000 of net proceeds from a hypothetical sale, what could I put that in the San Diego market? What would my opportunity be? Am I going to make more cash flow? Am I going to make more appreciation? Well, in looking specifically at this position, I know for a fact that ultimately I can influence a property here locally, whether it's in the form of adding square footage, renovating the property, adding additional units, or having a play that makes more sense long-term for a larger consideration. Additionally, I have a local network, obviously, being a real estate broker and owning a property management company. So naturally, I'm going to work with myself, save time, being with a skilled agent who knows the market and knows how to improve properties to get value. I have a property management company, so naturally I'm going to have a little bit of savings as far as my management fees. And then on top of that, I'm going to be able to, look at additional cost seg options for additional savings on my tax bill next year. Also, last year wasn't the best year for my business. In fact, it was one of the few years where our actual revenue went down. Now that's important because that plays out into my ability to qualify for a loan. So that was a consideration to say, knowing that my income and my ability to qualify for a loan might be tight or might be challenging, is it still makes sense to consider purchase options in this market? And then long-term planning, ultimately, what am I trying to accomplish in the bigger picture? If I can have assets locally, that could help me in many ways as far as helping family, helping friends, but also being able to then reinvest into a larger asset to continue my wealth journey locally with more control, more influence, and more outs to win as a real estate investment owner. Preparing property for sale. So here we are, we're looking at preparing the Charlotte rental for sale. And it is now November, so tenants have moved out. Shocker, it needs some work. So we're looking at what do we do for the property as far as preparing it, meaning do we paint it, do we polish it, and do we pray for it? What do we do? And also kind of what is the mindset behind preparing the property? So what repairs or improvements we're gonna do? Naturally, paint is always gonna be a large line item for you to consider and always do, depending on the condition of the paint, given the return you're gonna get. So what I want you to focus more on in this section is really, it's not an expense when you're looking at investing money to prepare your property. Really, it's a chance for you to make, well, more money on your money. And what I mean by that is ultimately when things are done right with the right budget and the right scope of work to prepare your property, you'll be rewarded in the form of less time on market, more offers to choose from, and a higher price, which ultimately is what we want to desire in selling a property, not the alternative, which we're gonna go through. Secondly, what are the main things we wanna do? Well, I already had flooring done and I already renovated the property before I rented it out. So in this case, we're really looking at details and we're looking at curb appeal. So what were some of the things that we looked at doing and that we did? Well, we did a landscape cleanup, which had not been taken care of in quite some time. So I was the neighbor on the block who wasn't looking up to snuff with the rest of the neighbors. So we had to do a landscape cleanup. We did a full interior paint. We replaced fixtures, lights, and really the detailed things to help bring the property full circle. However, we did not ultimately do enough on improving the curb appeal of the property. And what I mean by that is, well, when you drove up to the property, the grass was dead, leaves were everywhere, and the paint on the exterior looked quite stale. In fact, the majority of the front of the house looked pretty much blah. So why does that matter? Well, buyers ultimately are looking for a presentation and looking for a story. And the story that you want to be telling is that it's a property that's been well taken care of, right? With half repairs, like using your handyman to do a major plumbing repair, or having a bunch of patched walls that look like their kid did it. You want to make sure you're telling a story that it's a professional product. So the presentation looks good, it smells good, fresh paint, we have staging, right? We want to tell the story that this property has really been taken care of, and ultimately a buyer's going to pay more for that than they're going to pay for a stale, deferred rental property. So within that space, the mistakes made here is, well, not staging. I did not stage based on the advice provided for that particular market and price point, and the feedback showed. Secondly, didn't invest enough money into the presentation. Had I gone backward and redone it, I would have spent a considerable amount of money more on the curb appeal of the property so that we could be up to par with the rest of the neighborhood and ultimately command the price that we initially intended to. Lastly, the representation and the pricing. What's important is that you're educated on what's going on in that marketplace, meaning you're provided information of what's selling, what's not selling, who's the competition, and what's happening in the bigger picture for that market. The reason that's important is that if you get an offer and you have someone asking you what decision to make, well, if you don't have that information, you don't know whether it's good or bad. And that's critical to making sure you have the right agent representation. You should be receiving updates every week you have your property on the market to know what's active, who are you competing against, is anyone going under contract? If so, why? Are they priced better? Do they present better? These things all matter as far as making informed decisions that could be the difference between $10, $15 to $50,000. So ensure you're paying attention to the right things with hiring an agent. It's not about saving money on commission. It's about hiring someone who's informed, educated, to give you informed advice so that you can make financial decisions that ultimately support and improve your position instead of delay or take away from your position. Now, price right. Let's go through that journey of, well, what did it look like to realize a contract for it, close it? Well, our journey started with initial asking price of $625,000. And that was ultimately the recommendation of the agent that we could start there. And from there, we were on the market for over 30 days. We then made a price reduction to $605 and had to make a subsequent another price reduction to $590. So we're on the market for a total of 64 days here in Charlotte. And quite frankly, that's not what was expected. So we're on the market for 2 months while I'm paying holding costs. And ultimately, we did get a contract at $585. Now, that's not the price I wanted. And quite frankly, that's the price that I said I wouldn't go to. I wouldn't go below $590. However, being in that space at that time, the idea of re-renting my property out and starting over was just, quite frankly, not something I wanted to do. So I'm invested in this process through it, and I'm still able to accomplish a price that still made sense to do what I need to do here in San Diego. So I guess what I want you to realize here is that, hey, I'm a real estate professional, and I made some mistakes in hiring the wrong representation, making some decisions that did not support my ultimate goal, and yet I still realized an opportunity here to reinvest and ultimately get back that lost opportunity in the form of my new purchase. So if we're looking at the net proceeds, we walked away with $208,717. That will be my down payment for my purchase. And we have a total timeline of 45 days to identify my property. Just quick at a glance, we have 45 days, which means closed on March 11th. And I'm looking to identify or open a contract on a property or properties before or on April 25th, meaning I need to identify these properties on paper and submit them to my 1031 exchange accommodator. Now, last thing I want to mention on that front is obviously we have been looking at options, and I've been looking at the market, and I've been building a bench of potential options to purchase throughout the process of securing a contract on Charlotte and then ultimately selling it, which means that it's not really 45 days because we're starting the process, the search, well in advance of the 45 days to know what we're buying, why we're buying it, and quite frankly, why we're even selling. So let's jump into what it looks like for my buy box, meaning what specifically is my reinvestment target and what are my kind of must-haves and reasons that will support guiding what I buy or what I don't buy. Exchange, purchase, buy box. So this is very critical to the success of this process, is to having true clarity of exactly what a property looks like that you will purchase. Right? Oftentimes people are looking on the market at different properties or asking people for advice, but they're not really sure of exactly what are the pieces of information and the exact criteria as such that if I were to see it, I'm going to inspect, underwrite, and qualify whether or not it's a buy decision or a pass decision. So it's really critical that we understand how do we build this out and ultimately what is it going to do for us? Well, a lot of times it's going to put bumpers on so that we're not making decisions with emotion, but rather logic. So to start, how much money you have down? Naturally, that's going to play into what your budget is and what your options are. In this case, having $210,000 is truly on the lowest side you can be in San Diego in some cases, as we're looking at really the ratio of having 25% down at minimum. It would be the ideal outcome. So taking the $210,000 as a down payment, if we were to apply that method, that tells us we have a potential budget up to $840,000. Now, for my particular purchase, having the willingness and the knowledge and skills and network to improve and refinance and potentially pull the money out invested, I'm able to then maybe look at other options above that budget, but I also have to be careful about being conservative in that space because ultimately it is a game of inches and you don't want to be too far down or out of your ideal budget, which could then lead to other triggers or issues if you're not organized and disciplined in this space. So ultimately, I'm open to a single family or a multifamily, right? So options within the city of San Diego specifically. Now, why the city of San Diego? Well, those are areas I know best and ultimately have the most beneficial zoning and ADU options for a longer term play or more value to ultimately build on now or in the longer term. Also, to support that, obviously we have to have a certain lot size. We're looking at typically properties that are 6,000 or greater. That's going to be the combination that's going to get me enough space to have a footprint to even consider adding square footage or adding another unit. Now, are there exceptions? Of course. But what we're most paying attention to is how do we kind of really refine the search to get options that are within the most qualified, not all the options. Because ultimately that can lead to a huge distraction and cost you time, which in return could cost you money. Now, proximity to my office. This was an important one for me personally because my time is very compressed. I want to make sure that if I have to go and when I have to go to the property, I'm not committing 20 minutes plus each way, which means that every time I want to go there and inspect it, check on progress, or make considerations, I'm not having to dedicate at least 45 minutes just to get to and from. That over the course of a year, well, that can add up significantly. So being mindful of that and having past experience of projects that are further away, that was definitely an important criteria for me. But as I said, it's going to be specific to your situation and ultimately where your team of professionals is serving you. Lastly, add value opportunity. What's most important to me is that when I'm looking for purchase property, I establish as many outs to win as possible. So not just renovating the property, but being able to add square foot, being able to consider adding a unit or two, or having zoning that might be a higher density down the road. These are all things that we want to look at on top of our main criteria, because ultimately if you can have 4 options to win versus 1, you're always going to want 4, right? So next we want to look at what is the investment analysis process? Well, it's a process, meaning, right, we want to make sure to stay disciplined, so we have to have a checklist. It's the moment we start making exceptions that sometimes we might get ourselves in a situation where we might be talking ourselves into a property or making exceptions that ultimately don't serve us in the long run. So what is our checklist? Well, we're going to have our whole worksheet. That's going to go over what is basically our pro forma for the property, what we expect to earn, how we realize net income, and what that return might be on our money. Secondly, as I mentioned, we're going to look for additional value considerations. So what are other plays that I might be able to do longer term or in the near term to realize value or ultimately generate more income? Have a team of professionals. So when we're going through this process, you want to make sure that you're enlisting your team of advisors, your real estate professional, your property management team, your lender, and a contractor. These are people that are going to help you make this decision. So it's critical you have people that you know and trust and are qualified to give you solid advice to make these purchase decisions. So understanding what the property will rent for, understanding what will the property be worth after I do repairs, and understanding what's going to cost me to renovate the property, how long is it going to take, and on the loan side, what are my options to maybe refinance or stabilize the property to pull money back out. If we're not strong in these components with our core 4, these are other areas where, right, there might be issues or red flags that could ultimately cause you to have a less successful exchange or a less ideal outcome with your reinvestment purchase. So what we're going to do is we're going to go through this process of what we do and how I do it so you guys can see exactly what it looks like, you being a bird's eye view of me analyzing a property here in the local market to help really drive the point of what this process is and what it will do for you as far as the information you gain and how you can make a clear, concise decision. Now, the last thing I want to mention is the other component that can be important and critical to the deal structure and finding the right property ultimately does lay on motivation of the seller, situation, and timing. Ultimately, if you can't accomplish the purchase in the timeline you need, it's not going to be a consideration. Or if the seller needs time that you can't ultimately provide, that's not going to work either. So knowing what the situation of the property is, the timeline of the sale, why the seller is selling in the first place, these are all additional components to understand this deal from top to bottom and understand ultimately where does this stack up among other considerations and whether or not it's worth reviewing further, taking action on, or dumping it. So let's get into analyzing property here in the San Diego market. Okay, let's quickly review our investment analysis. We're going to look through the hold worksheet. We're going to look at additional value considerations. Make certain we have our core team of professionals, which is our real estate advisor, property manager, contractor, and lender. And then ultimately, what was the seller motivation situation and whether or not the deal timing makes sense and supports your exchange or consideration. So first thing we're doing is we're going to go with the hold worksheet. What's the hold worksheet? Well, it's this. It's what's going to help us really understand with clarity exactly what the numbers are and what we can expect or what our opportunity is. So in this case, we're going to go through Onondaga Avenue. This is the property that we were able to identify, or I was able to identify and put together a contract on. So I'm going to kind of work backwards to say, what was it like when I was looking at it? Well, here's a quick analysis for that. What we're going to do is we're going to go through list price, fair market value. Obviously, the list price is the list price. Fair market value, that's up to you to determine whether it's online or your own opinion, or preferably your professional opinion from your realtor. Next, purchase price. We were in the property for $830, and I had a total of 210 down. So we have 25% for the down payment. Amount finance, $620. Repairs and closing costs. I'm not going to put the repairs in for the renovation. To keep this simple, I'll just put in the closing costs. Put $5,000 in, as there was no loan origination fees on this one. And in return for not paying those, I'm going to be paying a 10% interest rate. So I might not pay on the origination, but I'm paying on the monthly payment, which is going to be a 10% interest only private loan. So as you can see here, I have my monthly mortgage payment of $5,440. And then we're going to look at our income and rents, right? So for this particular property, we're looking at a detached property. So only going to be one unit, and I'm estimating the fair market rent to be $5,400. Now, one way you could obviously analyze and look at that is employ your property manager. But what you can also do is you can check out Rentometer, which is a source that we use to help understand what the market is and what our options are. So if we were to look at Rentometer, we're going to see that the median rent price is approximately $4,700, I believe. So under that, we are going to be under market, or well, we're going to look like we're estimating high. However, in this case, this example is not going to be about cash flow, so it's okay. The next thing we're going to do is vacancy rate. That's typically going to be, I'd say 5% would be appropriate in today's market. Then let's look at the expenses, right? What's it going to require for us to be able to operate this asset? So property management fee, I put 150, which I own the company, so I'm just paying myself, I suppose. Maintenance reserve, $75 a month. Although it's going to be a brand new property, we also understand that things happen, whether it's an appliance leak, a plumbing leak. These are all things we need to account for, even if the property's in great shape. Also, just to go back to leasing costs, typically property management companies are charging 50% of the first month's rent for placement. So if you're using that instead of management fees, you want to fill this in. If you're doing both, then you'll probably get a benefit from one or the other if you're doing both placement and lease cost. Utilities, that's going to depend on whether or not you have a multi-unit that might have shared utilities, or if you have detached. In this case, I won't be the one paying utilities. However, I do have a solar system, so I take that back. I am going to be paying $215 a month. But what I'm going to be doing is charging a flat fee for electricity for that. So it's going to be an offset. So I will take that away for now. Property taxes, I'm doing 1.2% times 830,000. So it's going to be $830 a month, $996 for the total. Then insurance is $158, which right now I'm using vacant insurance for renovations, which will change to a regular non-owner occupied policy upon completing. And we're looking at about $158 a month. Outside of that, other costs to consider is obviously landscape maintenance, mow, blow, trash cleanup, tree trimming, just maintaining the property, or maybe you have other fees associated with how you need to maintain the property or features the property has to offer. So keep in mind, it's always better to put more than is less, so that if you do end up in a situation where paying that, at least we've accounted for it. As you can see, we are looking at a significant negative net cash flow. And the example I just put together here, it would be suggesting a net cash flow of negative $1,600 a month. Yikes! That's not exactly a property you'd be pursuing for cash flow. Now, the reason I wanted to show you this is, well, quite frankly, it's the opposite of what most people show you. They want to show you the best deals on the market. And I wanted to show you this example for the sake of understanding how I'm looking at this opportunity outside of income. So for me, I'm 37 years old. Right now, I'm in my income earning years. And what's most important is that ultimately, I am building wealth and using my skills and my company to help improve and force equity, because that is currently the best opportunity that I can realize. Recognize this is different for everyone. So just get clear on kind of where you're at, what you need, or maybe what you want, and ultimately what might be the best manner to serve you in that format for your rental property, or getting out of your properties and going to a passive fund. So exchange analysis. Let's just quickly take a look at the specs here that we went over for the whole worksheet. As we can see, we got 25% down. Our loan payment is expensive, and we're not cash flowing. However, let's go through the checks. Whole worksheet, fail, right? Our cash flow was even greater than negative 1,200. But here's what I want you to really pay attention to. We passed, or meaning we won in other categories, such that by doing so, it allowed me to move forward on this, even though the monthly payment and the financials don't make sense for this current phase. So, on the flip side, what were the add value opportunities? Well, for this property, there's a lot of them because there's a bigger lot. And I want you to understand that that for me was a big deal, because ultimately I'm looking to use my skills and my network. So here's the property right here for Onondaga. As you can see, we've got a pie-shaped lot. So what's interesting about this is that there's actually no rear or back of the lot. So we have two side setbacks in the front. What I like about this property is that I have options to add another unit, add more parking, garages, and I can pull off the back, and it doesn't take away from the integrity of the lot. There's still plenty of space and other considerations after an ADU. So for me, that was crucial. Secondly, I have an opportunity to ultimately build something, and in return, the opportunity to realize a lot of sweat equity. So really what I'm looking at is, I took my Charlotte property position, which was just under $200 a month in net profit, and I turned it into a negative 1,200. However, on the flip side, in return, I'm getting $250,000 of sweat equity or appreciation. So naturally, that is more important to me, and that will serve me better, because ultimately, it would take a lot longer to make $250,000 off my passive income stream. Next, the other benefits I can realize from this that ultimately sealed the deal for me were, well, I can use cost segregation again. So I can realize tax savings at the end of the year. Education for you, for my audience in the Emerson group, to get to follow along on our YouTube channel to learn more about our journey of purchasing it, demoing it down to the studs, and now we're building out a plan with our architect, Paul, to put together the best product with reworking the floor plan, getting it renovated, rented, and then refinanced, so we can move into phase 2 for the ADU. So again, looking through all these things, we hit all the buckets except for cash flow, and it's okay. We still won, because that's what's most important, where I'm focusing and where I'm choosing to build wealth. Now for yourself, that's what I want you to realize. What is your opportunity, or what is it that maybe you haven't given yourself permission to do because you maybe look at it in one capacity, or you only had to be able to realize this and it wasn't making sense for you from a cash flow. So I trust you'll be able to take this and say, hey, maybe there's other opportunities or options I didn't think about that might change my viewpoint, my opportunity, or my motivation. For the Onondaga investment, I want to show you guys the just specs here of what we're looking at for quote unquote phase one. We're going to remodel, refinance, rent, and reassess. So we have purchase price 830, remodel budget of 180,000, a holding cost of 60,000 thanks to my 10% interest only loan. And we have a quick overview of the scope of work, along with what do we think we're going to realize. And look forward to you guys trailing along to see if I hit it right or hit it wrong. But either way, you guys are going to gain knowledge from it. I'm going to learn from it, and we're all going to keep building wealth and continuing to make more informed and intentional decisions in the investment space. Okay, so what are our takeaways from this call? Well, first and foremost, I hope that you appreciated getting to see a real live situation with actual figures and details. That was the goal here, to really see what was my decision-making process, what did I have, why did I look at it, what were my considerations, and ultimately, why did I choose to make the exchange to San Diego? And from this, I trust that your takeaways are that there's a lot of ways you can win. It's not just about cash flow, and a lot of times it's not just about money. In fact, most times it's about helping people accomplish things for simplicity, better serves your life. Maybe it helps their family or friends. Or quite frankly, they just plan well their entire life through this real estate journey, and it doesn't matter if they do something or not. But either way, being informed of what you have, how you can win, and making sure you understand that we have to have core professionals in our journey to make sure that we're making informed and skilled decisions so that we can continue on, build, pass on, and protect generational wealth. Outside of that, join us for our Onondaga journey on our YouTube channel, where I'm going to be breaking down all kinds of good stuff, whether it's good, bad, or funny. And you're going to learn a lot about our construction process, the considerations that went into the renovations, adding square feet or not, adding an ADU. But we're going to have a fun time with that. So stick around and have a wealthy rest of your weekend ahead. Until next time.